Now you've got the monetary assets, gold and silver, and I believe it will be silver first. If those fail to deliver, then you got a real problem because those are money that compete versus the currencies that these central banks are able to freely print as much as they want anytime they want. And I could envision China just hauling dump trucks into their national stadium and going along with the camera and saying, see, this is gold, this is gold, this is gold. And they count the trucks and they say, we got 35,000 tons or whatever the number is. We showed you ours, you show us yours. It's gonna
And
be a
what if
moment of truth.
and what if we can't come up with the gold? What does that mean?
Well, the dollar is toast. It's completely collapsed. And then who's going to trade? Who's going to trade with the U.S.? I mean, if we're taking in a trade deficit of 500 billion or $1 trillion a year, the current month of January is not a delivery month, and I think we're at 35 or 40 million ounces standing for delivery. That is the largest January delivery ever. Normally, it's a million, 2 million, 600,000. It's like nothing. There's no historically no deliveries get done in January. So for 30, 40 million ounces to be delivered in January, that's outstanding. I mean, it's an outlier. A big delivery month is March. So March 1st, we get first notice day and we'll find out what starts to stand. But what's happened over the last 2 or 3 years is that you start with, let's use the number of 100. You start with 100 contracts standing for delivery the first day of the month. And by the end of the month, you might be up to 200, 300 or more contracts standing for delivery. It used to be the other way around. You start with 100 and you end with seven. Now we're starting with 100 and ending up with 200 and 300. So what we're witnessing is contracts are being bought during the month with the express intent of taking delivery. And March, the month of March, that delivery month, very well could be the failure to deliver because there's only 120 million ounces available to deliver. I do believe, and I mean, you could see a $10, $15, $20 pullback in silver. You could see two, three, $400 pullback in gold. I don't care. This rally in the metals, I believe, is the rally you do not sell. And the reason you do not sell is because where are you going to put the money? Where's your alternative?
Yeah, where are you going to
And
put it
the
in? Fiat
problem,
currency?
yeah, the problem with trying to trade is mathematically at some point we are going to go through a failure to deliver. And when we get to that point, and if you were being so cute as to trying to pick the top
Mhm.
and then trying to buy back in, there won't be any metal to buy. So don't be cute. This is the end game. It's the rally you don't sell.
Bill Holter, Mr. Gold, reveals why the current precious metals rally is the one you don't sell. Japan's bond market collapse signals global credit event gold is sniffing out systemic default risk. Comex silver deliveries at record highs, 35 to 40 million ounces, standing in January, normally 1 to 2 million, signaling imminent failure to deliver. When silver fails first, there will be no metal to buy back.
What that shows is that the Japanese bonds are being sold. That chart is of interest rates, not the price of the bond. If you put a chart up of the price of the bond, you'd see that the bond market is collapsing. And why this is important is because the yen carry trade is what funded for years and years and years a lot of the capital going into stocks, bonds, even real estate across the world. I mean, it was basically the piggy bank to borrow from because interest rates were non-existent. I think the 30-year was like a half a point or below a half a point. The yen was a stronger currency than it is now. And what you have is those that borrowed in yen. Now that interest rate has gone up and the yen itself has gone down. So it's a double whammy on those that borrowed. It makes it harder to carry because the interest rates are higher, and it makes it harder to pay back because you're using yen to buy dollars to pay back. So it's the carry trade blowing up, and understand that the world is 100% financialized. Everything has been financialized, and this was one of the early uh, credit markets that funded the bubbles, basically.
Why is Japan so significant? Does
Well, it's significant because this was the mechanism that they used to create capital, to borrow uh, capital to put into other markets. And
Mhm.
now you've got interest rates going through the roof. You've got the yen cratering. And what does Japan have that they're able to sell to try to slow this or stop this or whatever? The only thing they have, or the biggest thing they have, are US treasuries.
Mm.
And they own what, 7 trillion of US, I'm sorry, the Japanese bond market is 7 trillion. Japan owns 1 trillion thereabouts of U.S. treasuries, and they're gonna start selling those, and that's gonna put more upward pressure on our yields.
The yen carry trade, unwinding fuels. Global capital rotation into real assets. Central banks buying gold because they fear gigantic black hole of nothingness in dollar holdings. 1.5 trillion US dollars interest payments equals mathematically untenable. This isn't inflation hedge, it's default protection. The endgame, monetary reset with gold-backed currencies versus CBDC chaos.
And if you go back a couple of years ago when the Fed went through their first easing cycle, uh, they eased, but market rates actually went up anywhere from 0.75% to a full percent. Now we're in another easing pattern, and the question is, what happens to Treasury yields? Do they go down or do they go up? And if they go up, then what you're looking at is the central bank, the Federal Reserve, is losing control of the yield curve.
Yeah, it gapped up higher yesterday as well. This was a common theme across the bond markets.
Right.
So we're currently trading at 4.28 on the 10-year yield and 4.91 on the 30-year yield. And it's like you said, in 2024, if we go back down here, you'll notice a big uptick. This was around when Powell started cutting rates, and
Right.
it had the opposite effect on the 10-year yield. It
Exactly.
actually spiked up. So what is it? What would it portend if we see the same phenomena arise again once they start cutting rates heading into the rest of the year here?
Well, if that happens, it's a complete disaster for the central banks because it means their policy no longer works. But if you overlay the bond yields in Japan with gold, they're in lockstep.
Yep.
And it makes sense. Yeah, there you go. It makes sense that gold and Japanese yields are in lockstep because what what gold is sniffing out is a credit problem. Now, most people think that you buy gold to protect against inflation, but you also buy gold to protect against, more importantly, you buy gold to protect against default. Uh, and that's what this market is sniffing out, is that there are serious fiscal problems in Japan. And there's serious fiscal problems all over the world. And you'll see that you'll see gold uh, going up along with bond markets around the world going down and currencies around the world going down.
Well, it seems like now we're in the midst of Davos World Economic Forum. There was a clip going around yesterday of Ray Dalio pretty much saying what we're talking about today. I don't know if you saw it, but he pretty much said that the
Yeah,
existing monetary system is over, and that's why you're starting to see
right.
flight into gold and silver and monetary metals. And yesterday,
Okay.
something else also happened. I don't know. You may have caught it too. But the market sold off pretty
Right.
drastically. But gold silver, platinum, oil, natural gas, and even the equities in all of those respective metals and commodities, they all spiked higher. So it's as if there was a decoupling. It's as if we're witnessing a decoupling.
Right, we are.
Yep, of metals, energy, metals and energy stocks away from the broad stock market.
An ounce of gold is an ounce of gold. 100 years ago and 100 years from now, it does nothing. It doesn't go up. It doesn't go down. It just is. What changes are the currencies. And I've had people ask me, we've had such a big run in gold, such a big run in a bigger run in silver. Should we be selling? I'm going to tell you, or I'm going to ask you, if you sell, where do you put the money? What currency do you hold the money in? Where is anywhere in the world a credible currency that you can confidently hold that capital? The problem is there is no credible currency in the world today. So that's what's happening is currencies are collapsing. The fiat system is failing. The experiment, what is it, 80-year experiment since 1944, Bretton Woods, and then again from 1971, that fiat experiment has failed. And people are seeing the failure and they're getting their capital out of currencies and into real money, gold and silver. I mean, why are central banks buying gold? Basically because they don't trust the large balances they have in dollars. They're worried about a gigantic black hole of nothingness where they had dollar holdings. So that's why they're buying gold is to plug up the holes that are going to be created by fiats. And just a perfect example, and I think I read the number this morning, Russia's admitted, and when I say admitted, I believe they have much more than what they're saying, but Russia's admitted gold reserves have risen $260 billion since the United States stole their $300 billion. So that's an example right there of a central bank holding gold that makes up for the losses in fiat currencies held or treasuries credits that are held.
And that's on the silver front. Do you see any danger on the gold side?
No, gold is not as tight as far as the deliveries versus the available inventory. But I mean, it's the same thing. You've got constant demand from central banks. I forget which central bank overnight announced they're going to buy another 150 tons this year. I mean, it used to be, if you go back to the year 2000, it used to be people would wait for announcements from central banks telling us how much gold they were going to sell. And of course, it pretty much ended in 1999 with Gordon Brown. They called it the Brown Bottom, where they sold, 60% of Britain's gold at, well, I think the number was $280 an ounce or something like that. So it used to be that central banks were sellers, but now they're buyers. They're buyers all over the world. Western central banks, the Eastern, all the BRICS central banks, they're all buyers. So the demand is there because central banks are fearful of a credit default because gold is the only monetary asset that they hold that cannot default.
Is there anything you would trade into? So I get the perspective that you wouldn't want to trade in your precious metals for fiat currency. That's currently, we're witnessing devalue in real time. But would you trade it, would you trade gold into platinum? Are there any other sectors within metals or in, commodities that you see as better value right now for someone that is looking to allocate capital into?
Yeah, platinum and palladium are more industrial than anything else. And if you get a major hiccup in the auto industry, a lot of that demand is going to go away. So, I mean, I would stick with silver and gold. They are more money. I mean, gold is pure money, but silver is more money has a monetary history compared to palladium and platinum. Um, there are no currencies anywhere on the planet to put your quote your winnings if you were to sell gold or sell silver. So, okay, let's look at other assets. The only other asset that I can think of would be if you live in a city, you're not going to survive when this thing goes down. You've got to be outside of a city. You've got to be rural. So if you've got big winnings in gold and silver, take some of those winnings and relocate yourself and get the hell out of Dodge. It's a monetary event,
Mm.
is what you're looking at with the commodities. Commodities are looking at the purchasing power of the fiat currencies, and they're watching it drop. Um, Oil, yes, you're going to have people that look at oil as a commodity, but it's used pretty much immediately. It's not stored, and it's used up. It burns up. So oil's a little bit different than say steel, because steel you buy steel today, you still have it a year from now or 5 years from
Mhm.
now. Um, the softs like wheat, things like that, those get used. But the biggest movers have been the call it gold, silver,
Yeah.
the real deal.